Hello and welcome to our final investment update of the year from Hearty Wealth Management, where we talk to one of our managers from 24/7 Investment Management. So we're going to be speaking with John about the changes that we've done over the last quarter, what's happened, and where we think things might be going. So, John,
Morning.
morning. Give me a brief update of what's happened in the last sort of 4 months. I know that's quite a big question.
Okay, not a problem. So the last 4 months have actually carried on how the start of the year carried on. Equity markets have been the main driver of returns. They've been exceptionally strong, broadly speaking, across the globe. The US, heavily led by tech and AI performance. UK and Europe actually got a bit of love by global investors because they were very attractively valued. And Europe actually had quite a lot of fiscal stimulus and increased defence and infrastructure spending. Overall, broadly speaking, equities have been the outright leader in those terms. Alternatives must get a mention. It probably would be amiss of me not to mention gold's performance, which I think everybody knows. But gold, again, in the last sort of 3 or 4 months, must caveat, has had a recent dip off, but still above $4,000. It's been exceptional year to date, the gold performance. It's improved for a number of reasons. Decrease in inflation, decrease in interest rates broadly, geopolitical volatility still in the environment, and investors still like it's safe haven, for want of a better word, it's safe haven demands, and its sort of diversification benefits. So global equities and gold have been the main drivers. Fixed income has been, I'd call it a net positive, not been a negative, broadly speaking, just ticking away. That's where I'd sort of say. The big driver in the last 3 or 4 months has been the Federal Reserve, which is the US central bank. It enacted its first rate cut of the year, which global equity markets were really looking for throughout the year, and it physically came in September.
Yeah, great. Obviously, you spoke about that gold's done really well and so on. And normally we only do our changes once every sort of 3 to 4 months, but we actually did a change in September, didn't we?
Yes.
So can you talk me through that, please?
Yeah, there was 2 elements to that. The first element was on gold. So at that time, it was about mid-September, about the 17th, we had 2 gold funds. So we decided off the back of exceptional performance in both, we'd basically take profits, we'd trim our position a little bit, essentially taking a bit of risk off the table and taking a bit of profit. So we held the 91 Global Gold and the Jupiter Gold and Silver Fund. We essentially trimmed the overall allocation slightly and consolidated into just the Jupiter Gold and Silver. The reason we remained with Jupiter Gold and Silver is, as the name says, it's not just gold, it's silver, and it also has a little bit more precious metals exposure, so it's a bit more broad-based. But Jupiter Gold and Silver, it's been a fantastic performing fund. And on the 91 Global Gold, we just released that because that was essentially the punchier of the two. And while we're talking about silver should get a mention. Like gold, it's been an exceptional performer year to date, and that's been influenced by take up in clean energy.
Okay.
So silver has sort of arisen from a little bit of a slump over the past few years.
Great. Well, you don't hear much about clean energy at the moment. Not so much, at least our portfolios are doing a little bit of good.
Yes.
Side. So also we went to what's called a -1 position, didn't we? Can you just sort of explain what a -1 means for our clients?
Yeah, not a problem. Good point. That is the second part of the change that again took place mid-September. So approaching that date, we were neutral in equities. So for instance, a balanced at neutral would be 50% equities. -1 is a slight dial down, so reducing your allocation, and we reduce in one step by 5% of the neutral allocation. So balanced went from 50% equities to 47.5. The reason we did that was at that point in the year, equities have been on such a strong rally and quite sharply as well, broad-based across all markets. We thought it was quite prudent to look at the future. Valuations were starting to seem a little bit expensive, and off the back of such a strong rally, we decided just to take a bit of profit, bank it, and basically focus not on the negatives at all, because we're still positive on equities. We just thought it was prudent to take that little bit of risk off the table.
Nope, that makes a lot of sense. So essentially we just de-risked a little bit because it's been a good year.
Absolutely, because when it's been a good year, it's been almost an exceptional year in equity markets. So it was a case of the profit was on the table to take. And I will sort of go a little bit more detail on, it was core equities we reduced. So equity income funds, they stayed the same. So the more punchy equities were reduced. The equities, i.e. equity income, They focus more on downside protection, sort of negative environments. We've kept them the same allocation. So the portfolio's still got a strong downside protection if markets sort of change sentiment and look a little bit more negative.
Yeah. So when you say equity income, you mean things that might have more of dividend effect and so on like that?
Absolutely. Your more boring, staple, dividend, stable areas of the equity market. Yeah.
And not American companies, essentially.
Not American companies.
British companies.
Yeah.
Great. So now we've obviously gone through what we did a few months ago. What did we do in our most recent scheduled change?
Yeah. The recent more scheduled change, as you say, was the start of November. It was the first week in November. It was the 6th. This encompassed a few changes. So bear with me and apologies if the list's quite long. There's about 4 or 5 major changes. So the first one was we had an LNG Global Infrastructure Fund. It was a simple like-for-like swap to an Aberdeen Global Infrastructure Fund. This was based solely on they essentially do the same things, but we can access Aberdeen at a cheaper cost, which is obviously an overall benefit, and it's got a slightly better risk-return profile, a double benefit. It was just a share class that's become open to us. Second major change was clients might see HSBC Pacific exit the portfolio in favour of 2 new funds. So it was a 1 fund into a 2 fund switch, and the 2 new funds are blended. And you'll see a Fidelity fund, Fidelity Index Asia Pacific, excluding Japan, and you'll see an Aberdeen one, Aberdeen Asia Pacific, excluding Japan. The reason we made that change was HSBC Pacific has been a fantastic performing fund, so it became opportune to switch into 2 less risky. And by less risky, I mean HSBC had a heavy, almost 20% weight to 1 stock,
Oh, wow.
which was TSMC, Taiwan Semiconductor Manufacturing Company. Again, it's performed exceptional, but it's a very severe concentration risk. So we decided on the basis of it's performed exceptionally up to that point, we're going to de-risk essentially. And the 2 new funds blended together, it offers more country-wide exposure, not just one in Taiwan. So now the Pacific sort of region delves into more China, India, Australia. And net, there's no effect on fees. It's essentially a like-for-like costing.
Great.
So it is a de-risker. The third one, Aberdeen Global Smaller Companies, clients might see that exit the portfolio. That has been on the watch list on performance for a while. And we've accessed Janus Henderson Global Smaller Companies at a preferential share class, founder shares. Huge cost saving. Janus Henderson has been a much better return profile. Very good fund. Nicely widely spread across the globe as well. But one key reason we accessed it at Aberdeen, a few of the members of their senior team left, which was we weren't too optimistic about. These guys are the idea generators. So that was the sort of like the final nail, so to speak. And the last change was we did a slight dial down in fixed interest and cash overall, not a huge one. And this was to make way for the addition of an absolute return fund. So the absolute return fund sits in our alternative basket, and clients will see it as M&G Global Total Return. It's a long-short fund. I won't go into the technicals, but it basically gives diversification away from bonds and equities. So it's a lower risk profile, it's a steady return profile, and it's an exceptionally cheap cost because we got preferential share class treatment. It helps complement some of the riskier stuff in the alts basket as well. So overall, it reduces risk of the portfolio and gives the alts basket another sort of string to its bow. And the last change was a regional change. We took a little bit of profits from Asia and the Pacific region, as mentioned. We slightly dialed down the overall allocation, and we allocated to the UK and Europe just on valuation grounds and to make the portfolio more balanced.
Okay, great. So what I'm hearing is generally just tweaks, although they might look like quite large changes.
Yes.
A little bit of lowering of risk, which is kind of what we want at the moment.
Yeah.
And of course, actually, it sounds like a bit of a reduction in cost as well.
Yes.
Overall, which not by much, but a little bit, which always helps.
Absolutely. Overall, I'd summarise it is basically a cost neutral across all changes.
Okay.
And absolutely agree. We had a view on the risk side now, because it was great to get optimistic about the market performance, which has been exceptional. But we're always cognizant that we've got to look at what if things change. We want to be prepared for all scenarios. And I think we set a quite a nice risk profile now.
Okay, great. And obviously this year, the performance has been very good. Where do you sort of see things going? Because obviously we've done the changes. It's always a choppy time. I'm not going to go into politics or anything.
Yeah.
Because it doesn't really actually impact things that much. But if we were sort of forecasting with these changes, what's the next sort of quarter, hopefully, looking like?
Yeah, no problem. You raise a good point. I think it should be it'd be remiss of me not to mention portfolio performance because clients will want to hear that. So currently, as year to date stands, all our portfolios 2 to 8, defensive to dynamic, they're above their respective weighted benchmark, which we're obviously really happy about. But going to one of your questions about where do I see things, where would it be positive on an area? I would say UK smaller companies, and I know that might turn a few heads, but I'll give a few reasons why. UK smaller companies, as it stands, are extremely well valued against the larger peers. And by smaller companies, I'm referencing the FTSE 250 and lower space, so not FTSE 100. It's important to look for value in markets. And when all valuations seem to be rising, sometimes you have to look at things that may be a little bit less loved. But with the interest rate cycle now looking in the UK term, we're looking like we're probably going to get a cut in December. When interest rates start to fall, your smaller companies tend to get the biggest boost and biggest bonus. UK smaller companies have been unloved for a number of years. So I'm giving this, let's say, forecast on a medium term basis. I'm not expecting an instant turnaround, but I'm just saying it's fantastic value. There's fantastic companies. Smaller companies will normally perform better by nature because they've got ability to grow quicker. They've got more room to grow. Valuation perspective, fantastic profile. And the rate cutting cycle should heavily benefit UK smaller companies.
Okay, great. So actually things aren't quite as bad in the UK as they maybe seem.
No, and one additional benefit I would say is there's been that much negative news, as I think we both know, priced in. Sometimes more negative news won't affect things so much. We're now trying to look for the positive news, which should have an actual added bonus.
Yep.
Because the market seems not to want to accept any positive news in UK smaller companies. So when that comes through, whether it's policy reform, maybe more investor flows, maybe interest rates fall a little bit more than people expect. When the good news comes through, we should see this sort of amplified. That's the hope over the sort of 3 to 5 year term.
Great. So just to sort of summarize it all up, what we've done is we've kind of done a bit of de-risking already.
Yep.
So we don't really need to focus too much on that side. We've also not got masses in the US anymore, do we? In comparison to many other.
In comparison to peers or the peer group who might be heavily overweight US, sort of in the 60 to 70% of their overall investments, nowhere near that overweight.
Because we've got that UK, Europe, Asia sort of exposure.
Exactly, spread quite broadly across the globe with still a very, very decent chunk in the US.
Okay. Great. So we've de-risked a few things. Hopefully everything still looks relatively positive. And obviously we've done quite a few changes, but otherwise it's not much else to sort of go through.
No, looking for the point in the markets in the next sort of 3 to 12 months of a re-entry of that equity position that we're -1 in. So sitting in a favourable position on that point of view that we're waiting to maybe enter slightly again, rather than looking in case that we were overexposed. So we're sat very happy with the allocation across all asset classes.
Great. Well, thank you, John. Thank you for that update.
No problem.
And this is the final update of the year. So thank you very much for listening. Of course, if you ever have any questions, please give us a call or contact us, as you know, and all the details will pop up at the end of the video. Thank you.
Thank you very much.